Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, hi everyone. So, what we're going to do today is we're going to focus on finishing off the remaining slides from Lecture 2. Because I went through probably more examples than I should have, because I do love this area, I have quite a few slides to go on with. So that is going to be the biggest thing we do today. If we have time, we'll go through the other things I planned on doing this workshop, which is essentially a recap of some different ways to calculate return, both by hand and also using Excel. These are going to help you with Excel Video 1, and that's going to feed into tutorials in weeks 4 and 5. So if I don't have time to go through this part of the workshop today, then I'm going to go through that, as well as mean variance analysis next week. What I currently have planned for next week is a guide to how to use what we call Solver, which is a tool that that enables you to do mean variance analysis. So if I don't get through have time to do the Excel work today, then I'm going to do this and Solver next week. Now that said, I deliberately keep a bit of room in the workshops because if there are any areas that you guys are struggling with or you want me to go through more, let me know, because I'll happily add those into the workshops. Chances are, if some of you are a bit uncertain, there's going to be others that don't tell me the same thing. Okay, so if you'd like me to add anything into the workshops in these early weeks, let me know. By the time we move on to focusing on the assignments, then what will typically happen is all of you will let me know what issues you're having with the assignments, and I'll actually structure the workshops week by week based on the biggest issues you guys are having. So, by assignment workshops, I hope that it will basically be completely student-driven, but in the meantime, happy to add anything you'd like. It's a very loud mic. Oh well. So if you remember, where we finished yesterday is talking about the fact that there are problems with just using quantitative risk measures. Right? If you look at quantitative risk measures, so standard deviation, what are some other ones that we looked at other than standard deviation yesterday? Sorry? Tracking error is another one? Yep. So that would be if you have a what? Absolute or relative return target? Would you look at tracking? Relative, yep. So if you have a relative return target, you care about your performance relative to the benchmark. So you calculate the standard deviation of that difference in performance. What others would we look at? There's a really big one. If you think about the measures we looked at yesterday, there was one that came up again and again, different ways to measure it, but shortfall, that's it. Right? Remember, the classic measures like standard deviation, they don't focus specifically on the downside. They look at the spread of outcomes around its expected outcome, but they don't focus on the fact that in reality, what we care of is falling short of what we aim to achieve. Be that return, probability of loss, performance relative to a peer group. It's always, we want to do well, what happens if we don't? So the benefit of shortfall measures is it actually captures the downside without penalising upside. Because if we do better in return than we expected, we'll actually be happy. So if you think back to the measures that I showed you and that you'll calculate in the online video, and by the way, the online video will always go live at the end of the workshop. The reason I do that is that it gives me time to cover all of the material for the week before the online video goes up. If you guys would like me to release the online video earlier, again, let me know. This is your course. I'm happy to structure it the way that works best for you. But if you go, that's video 2. That's way in advance. Bear with me. If I go back to the online video solution file that I showed you yesterday, and we look at measures like the probability of loss, that's all saying how likely is it that the outcome is not what we want on the downside, right? So they're what we call downside risk measures. So all of these risk measures are useful. They tell us the risk that eventuated in the past. They enable us to extrapolate from that into potential risk in the future. But what it doesn't tell us is underlying causes of negative events. And the fact is the world doesn't repeat in the exact same way every time. So it's only when we understand the causes of market crashes that we can start to get snippets of things to look for that will help us predict if one is going to occur. And we need to be able to, at least in part, predict it if we're going to be able to change our portfolio to protect ourselves from it. Otherwise, if you want to be protected from risk, you need to be much more conservative all the time if you're not going to be able to predict it. So we finished yesterday by saying that there's a difference between parametric and non-parametric ways of characterizing the distribution. What is the classic parametric way of characterizing the distribution? What distribution is that? The normal distribution, right? In a normal distribution, we're saying that all we care about is mean and variance. Now, in reality, actual things like skewness and kurtosis are important because remember, we say that we care about downside. So to ignore skewness and kurtosis would mean that either all asset returns are normally distributed, which they're not. I mean, think about a derivative. That can never be a normal distribution. Or that investors have mean variance utility functions such that only mean and variance matter. If you've got a quadratic utility function like that, all right, you can ignore skewness and kurtosis, but it would also mean you don't care more about downside risk, which I also don't think is a good reflection of reality. So there's benefits of a normal distribution, but also downsides. So the alternative is to look at a non-parametric or a data-based distribution. In a data-based distribution, you take the historical data as it is, and you either take measures directly from the past, or you run something like a bootstrap to extrapolate what the full distribution might be. And you look at both of those in your online video. The benefit of looking at a database distribution is that you're not assuming mean variance. You're not assuming anything about the parameters, such as skewness or kurtosis being 0. The downside, though, is you've only got the data that's in your history, right? So if a bad event didn't happen in your data history, it's not going to be reflected in the distribution that you generate. The second issue when it comes to characterizing the distribution is that you can have instability in the return generating process. So in other words, the causes of things like variance can actually change over time. Do you guys know what I mean when I talk about algorithmic trading or high frequency trading? If I say that there's algorithmic trading, is that trading that's being done by a human or by a machine? A machine, right? Now, this has popped up in force, but only relatively recently. And it's a classic example of how the causes of return and volatility can change through time. Because before things like algos and high-frequency trading were around, essentially markets could only react as quick as humans can trade. Once algos came into the picture, computer-generated trading code would essentially, it can capture market movements and exacerbate them. That can actually mean that the market ends up more volatile. So have a think about this example. Let's say that you guys are running a pension fund and you're going to put in a massive buy order, what we call a block order. You're going to purchase a huge number of shares at once for a single company, right? Now, if you wanted to do all of that in one trade, what is the risk that you're going to do? You're buying a huge number of shares of a company. You're going to shift the price in which direction? Up, right? Because you've got excess demand. So what you do is you say, look, I've got to buy a bunch of shares and I don't want to push the price up. So what I'm going to do is I'm going to roll out my share purchase through the day. I'm not going to buy everything at once. I'm going to buy a parcel now, a bit more in a couple of hours, a bit more a couple of hours after that, and so on. The idea being, all right, you might end up raising the market price a bit because there is a limit to the supply and you've got a huge amount of demand. But by spreading your trades out through the day, you might shift the price up a bit in the first part of the block, But then you're going to wait a while and hopefully more sellers will come into the market before the next block comes out. So by spreading it, you're hoping to impact the price less. Now that's great in principle, but let's say that there's an algo out there that is trying to pick up trades that have started and are being spread out through the day. If an algo can pick up that a block trade has started and is going to be rolled out, what would the algo try to do at that point? So let's say the block trade is maybe 25% complete. What's going to happen? So we know that people are going to be wanting to buy large quantities of this stock throughout the day. So what would an algo do? Well, you'd want to make sure that you get in front of that trade, right? You'd want to buy, if you can identify that there's 75% say of the block still going, you'd want to buy the stock now. Because then, when the actual block trade comes in and the super fund is trying to make that big purchase, that's going to be pushing the price up and you can sell at the elevated price. Now, if the algo comes in and does that, essentially what they do is they speed up the price increase process. So that it's almost like the super fund made the massive block trade at the start, except the algo is the one that got some of those lower prices before the price went up. Okay, so with algorithmic trading, you can exacerbate market movements. Because if you know that you need to buy a huge amount, you can't roll it out in the same way because someone's going to come in and take advantage of you. So there's the incentive to just make the purchase all at once, but in doing so, you're going to have price impact. So the argument is, as things like technology come in that change the dynamics of the market, the underlying causes of volatility can change, and they can actually become more disconnected with the fundamentals. I actually remember I'll come to one thing. I remember actually that there are some people when I was in London that were saying that they will not trade. They trade over the counter, or they trade through their computer. They're different ones, but they trade through their computerized match-to-match trading. They're not going to use an exchange until the high-frequency traders remove themselves from that exchange. Yeah. Yeah. I know what you mean. It's true, but remember, so the idea is that would work as long as the price rise isn't your trade, right? So the way to think about it is, remember, you've got a bunch of people wanting to buy. If you think of an order book, you've got a bunch of people wanting to buy and a bunch of people wanting to sell. And a trade will occur when someone crosses the order book. So when the buyer that wants to pay the highest price meets the seller that's willing to sell it for the lowest, right? Now, if there aren't many sellers in the market, you need the buyer, if you need to buy a huge amount of shares, you need to convince the sellers to sell them to you, which means you need to go further up the order book and be paying those higher prices. So you're not buying it at 10, you're buying it at 10.50. Right, so the idea is, if you've got a big block trade, maybe your first few trades can be at the current price, but then you're going to have to go up the order book and pay more and more. And that's how you get the price impact. So you at least want those early shares to be at a low price, and that's where the algo comes in and takes those early lower prices away, and you're already further up the order book by the time you can trade again. Any questions on that? So the next thing you can have is you can have issues with the investment horizon that you pick. So we're going to actually focus on this in week 4, and I'm going to give you an example. But if you want to characterize the distribution, the way the distribution will look can be really different depending on whether you look at weekly, monthly, quarterly, or annual intervals. And that's particularly an issue if you have thin trading or appraisal-based assets. So a simple choice, like am I going to look at monthly or quarterly returns? Or in your assignment, your choice is going to be, do I use quarterly or yearly returns? Can actually have a big impact on your ending risk measures. And the last thing is that you can actually have, your data is only, or your outcomes are only as good as the data that you have to work with. So you can have major problems with the data, and one of them is a limited history. We have really good history for equities. They go back right through the previous century. We have pretty good history for bonds. But when we start to get into the newer or less liquid or unlisted asset classes, the problems start to climb. Let's take hedge funds. Hedge funds have what we call a selection bias. As a hedge fund, you can choose whether to report your returns. Now, let's say that you're a hedge fund that's doing really, really well. If you report your returns, it's advertising for you, right? You want people to know how well you're doing because it's the way that you attract funds. Now, let's say that you have a bad quarter or a bad year. Are you going to be more or less likely to want to report your bad performance? Less likely, right? Because let's face it, you want to advertise when you're doing well. You don't really want to promote when you have had a bad year in the markets. So what tends to happen is the best performing hedge funds do report their returns. The worst performing hedge funds often don't report their returns. So if you take the average of the hedge funds in the data and you compare it to the average of the actual distribution of hedge funds, do you reckon the average in the data is going to be higher return or lower than the true average? Higher, right? Because what you've got is the good performers, and the bad performers are actually, they're losing investors' money, but you can't see it in your database, which means that your estimates of hedge fund on a return versus risk perspective are going to be upwardly biased. Private equity, you've got a couple of issues with private equity. One of them is appraisal valuations, which I'll talk about in a moment. The other is it's actually really hard to get your hands on private equity data. And let's say you're an investor considering a private equity manager. What they tend to do is they give you what they call a sample of representative deals. Now, let's say you guys are private equity managers and you're trying to get my business. You've had a bunch of deals, you've undergone a bunch of transactions over the past sort of 20 years. And you're going to choose, say, 10 to give to me as an indication of what you do. Are you going to pick some of your worst performers there? You're going to pick your best ones, right? Because you're trying to get me to give you my money. So when you see sample representative deals in a private equity fund, you've got to question whether they really are representative of the average past performance for that fund. If you think about infrastructure, the trouble with infrastructure is there is almost no data available, right? So there is no history to put into your models. In that case, when it comes to the type of portfolio construction that we look at, people tend to proxy infrastructure using the returns of direct property. And I'll talk more about how to do that in our direct property and infrastructure week, because I'll give you guys property returns for the assignment. And if you also want to recommend infrastructure, you could actually split your property weight between the two and say that you're using direct property returns as an infrastructure proxy. So that's one issue. You might have a limited history. The next issue is thin trading or appraisal valuations, and they actually create the same problem. What do we mean if something is thinly traded? It's illiquid, that's right. What do we mean if something's illiquid? Say again? It's traded less and you end up taking a haircut on the price when you sell it, or you pay too much when you buy it, that's right. Now, the other fact is, because it's traded less, it appears in our data less, right? Because our data is only on trades that occur. So let's say that we have a thinly traded asset. This is time, and this is price or value. Let's say the asset starts at 100. Now, this is a volatile asset. Its price is jumping around a lot. Or at least it would be if people were regularly trading it. But they aren't. So all we can actually say is, we know that its value is jumping around a lot. And let's say that its value is sort of doing this. Right, so that if we were to trade it, we could be trading up here, down here, within the space of a week, right? This is a very volatile asset. But it's also thinly traded. So it means that people don't buy or sell it very often. If you think about the data, the only thing that can be recorded is not the value that would be traded had someone traded, because we don't know it. It's the price that occurs when it does. Now let's say that the only trades happen at time 0, say time 6 months, 1 year, then nothing happens for 2. Maybe there's another trade three months after that, and so on. Even though value is fluctuating wildly, the only thing that happens in the data is this. And maybe there's one here. So can you see how much more smooth the return series is in the data than the actual value is, because no one's trading it? So the problem is, what happens when you have thin trading is it leads to what we call smoothed returns. And what is smoothed returns going to do to our risk measures? Sorry, say again? Underestimate, that's right. And underestimated risk measures. And by the way, it's also going to understate correlation, and we're going to look at that in week 4. What I'm going to do in week 4 is I'm actually going to give you an example using direct property that looks at, when you have a market crash, how long it takes for the direct property value to be, for that crash to be reflected when you have appraisal-based valuations. Now, appraisal-based valuations cause the exact same trouble as a thinly traded asset. Appraisal-based valuations occur for unlisted asset classes. So classic examples are direct property and private equity. When a stock is traded on the exchange, every time somebody trades it, a price appears. So even if it's thinly traded, when those trades occur, you can see the price appear in our data. When an asset is unlisted, 1, it tends to change hands far less regularly, and 2, there isn't an automatic exchange where the trades are reflected in the price, where the price reflects the trades that occur. So let's take something like direct property. What tends to happen with direct property is that a fund will purchase direct property and hold it for a long period of time. What they'll do is each quarter they will get someone in to value the property at that point in time. Now, often these funds can have a large portfolio of property, so they're not going to get the valuer to value everything at once. What they tend to do is they get the valuer to look at 25% of their properties in, say, the end of March. They'll look at another 25% of the properties at the end of June. They'll value another 25% of properties at the end of September and another 25% at the end of December. Come March the next year, they will revalue the properties they valued in March of the previous year. So that means that each one piece of property is only actually valued once a year. So you can see the exact same thing is going to happen here, except for the fact that you're going to have it happen at regular intervals. Right? Every sort of, for example, every quarter, you will get a value. But in the meantime, the price will be absolutely stationary. So you've got, if this is price or value, whoops, it's going to be sitting at a certain amount until the next valuation, when it changes. Now, if this is every year, because this is a single piece of property, then the issue is if you're using quarterly returns, you're going to have a flat value for the first 3 quarters before a movement occurs. And then you're going to have a flat value for another 3 quarters before a movement occurs. So it looks like value is very stable, but it's not. All that's stable is the latest value that only happened, 1, 2, 3 months ago. If you actually wanted to trade that piece of direct property, who knows what the value might be in the meantime? It might have gone right down and be on its way to recovery. So again, you've got that issue of underestimated risk because you've got smooth returns. Any questions on that? So when it comes to your assignment, you're going to make some decisions over what data to pick, and this is the type of thing you're going to discuss and ultimately make conclusions about. The next issue is that the true nature of risk can be hidden, right? So remember, we looked at 3 different stages of risk. We said you had to start with the initial investor because who the investor is will depend on the risk that's most relevant to them. Then you make use of quantitative risk measures, but to really understand the risk, you need to look at the fundamental sources of that risk. So if you think about the GFC, we can observe it occurring by looking at the data, but the data doesn't tell us why it occurred. We went through this list yesterday. We said there were low interest rates, an easy supply of credit, highly leveraged property market, gaps in regulation, particularly around things like derivatives. There was issues with credit rating agencies, right? It's been corrected now, but essentially the credit rating agencies were attaching a far higher credit rating to these tranched up debt products because of a conflict of interest. And there was a mismanagement of risk and a misunderstanding of risk as well. It's really important that we understand the causes because we need to know the causes if we're going to have a chance to predict a crash occurring again in the future. Because the causes won't always be identical, but there will be similarities. And we looked at that when we said that there were similarities between the causes of the Great Depression and the cause of the GFC. The easy supply of credit, the low rates in particular, the exuberance in the markets. Another issue is that a lot will matter when it comes to risk that you can't incorporate into your quantitative risk measures. And the first of those is possibilities in extreme markets, because extreme markets are by their definition extreme, which means they're rare and unlikely to repeat in the same ways. So it's quite hard to pick it up in the data. The first example of this is what we call a black swan. Now, in financial markets, a black swan is an event that is extremely rare, has either never occurred or very, very rarely, and is therefore really easy to miss, or your data might not have it whatsoever. If it doesn't appear in your data, it's hard to predict it happening. The reason it's called black swans goes all the way back to when the British first landed on Australian shores. Does anyone know what colour swans are in England? White. They're white. So when the Brits landed in Australia and they saw a black swan, they were completely stunned, right? Because all of their data, all of their knowledge, their observations told them that swans were white. And yet here is this thing that looks like a swan, sounds like a swan, moves like a swan, but it's black, which doesn't make sense because swans aren't black. We've never seen one. It could have been rainbow coloured, for all they knew. Black swans didn't exist. Now, luckily for the Brits, the occurrence of that black swan wasn't catastrophic in any way. The Prince in Swan Lake, the ballet might disagree, but at least for the British, it was fine. In financial markets, if we talk about a black swan event, the occurrence of that black swan is typically devastating. A really good example of that is long-term capital management. Does anyone know what long-term capital management was? It was a hedge fund started by a guy called John Merriweather, and he's one of the best investors in the business. What's that thing in basketball that people play? It's really popular in America where they create their dream team. Does anyone remember what that's called? Like they have these fake basketball players and they say, if I had a team, this is what it would look like. I swear it's a thing. It's in a lot of movies. Anyway, imagine that you were going to create a dream team for a fund, right? If you could put anyone into a fund that was going to make money, what would you do? That's what long-term capital management was. John Merriweather started it. It had 2 Nobel Prize winners on the board, Scholes and Merton. It had the best programmers around, the best investors, the best analysts. It really was a dream team. And the goal of long-term capital management was to take up what they saw as arbitrage opportunities. They looked for tiny mispricing between 2 stocks that were essentially the same and therefore should have the same value. And then they bought the underpriced stock or asset, sold the overpriced, and waited for it to converge before trading out again. Now, I say they called it arbitrage because they did have to wait for prices to converge. So it wasn't actually risk-free. But at first, it looked pretty good because they found a lot of these tiny mispricing opportunities, and to make those tiny mispricings into big money, they leveraged through the roof. 25-to-1 was their leverage ratio. That is insane. And in the first year, they had a 20% return. In the second year, they had a 40% return, and they did it again in their third, another 40% return. Can you imagine if you gave your money to these guys and you got 20%, 40%, and then 40% on top of that? It was brilliant. The trouble is, in 1998, the black swan for long-term capital management occurred, and that was that the Russian government defaulted on their debts. All of a sudden, these trades that long-term capital management made, that they were waiting to converge, diverged. They did the exact opposite. So they started losing money fast. That triggered margin calls. So they had to sell off assets. Triggered more margin calls. Investors started getting worried and they started withdrawing their funds. That triggered more margin calls. And in a very short time, in a year, LTCM lost over $4 billion and they had to get bailed out. Right? It was an absolutely devastating crash. They never recovered. Ironically, had they been able to wait it out, their trades did converge in the end. They did. They could have made money. And the people that bailed them out did end up making money. But they went bust before they could. Because it wasn't risk-free. Right? So there's sometimes, even if it looks like a risk-free strategy that is making so much, you know, at the end of the day, if a black swan occurs, you've still lost everything. Other black swans more generally, the dot-com bubble and burst was one, World War I was another, 9/11 was another. They're events that are very difficult to predict, and so it's hard to protect against, but it doesn't mean you shouldn't try. The next thing that's difficult to incorporate into models are things like business risk, personnel risk, counterparty risk, governance failures, changes in public policy. We're going to look at a lot of these in our hedge fund week. We looked at changes in public policy yesterday when I spoke about the change in accounting standard AASB 119, where now defined benefit funds have to actually report their surplus or deficit on the balance statement, on the balance sheet and income statement of the overall company. But let's give another example for now, and let's focus on personnel risk. Let's say that you've given your money to one of the best active equity fund managers around. He really is fantastic. He has earned you so much money over the past 5 years and shows no sign of stopping. You're starting to get a lot of confidence in this guy, so you're probably not going to monitor the investment as closely as you might have at the start, because all he does is make you money. He is really skilled. His skill doesn't change. But something does change in his personal life, and I'm sorry, this is going to get a little dark. He goes through a divorce. He doesn't take it well. It's an acrimonious divorce. He gets depressed. He gets depressed and he starts drinking. He hides it for a while, but he's making some bad investment decisions. He makes a few more, he starts losing money fast. And you're not monitoring it that often because you're happy with this fund manager. And so by the time you realize, a lot of your value has actually disappeared. You can get out at that point, but you still lost a lot of your money. How are you going to put that into a quantitative data model? You don't know the marital status of your fund manager, and I'm pretty sure if you asked them, they wouldn't tell you anyway. Okay, so it doesn't mean that it isn't a risk, but it's really hard to put it into the numbers. Funding or cash flow uncertainty and illiquidity is another one. And a good example of this is an event called the quant quake. This happened just before the GFC in about August of 2007. There were a bunch of quant hedge funds in the market that thought they were all doing something really unique, right? If you remember, hedge funds don't need to report. If you're a quant fund, you work on creating a proprietary model that's going to help you to identify under and overpriced stocks. And based on that quant model, you're going to buy underpriced stocks, sell them when they become overpriced. And you're not obviously going to tell other people what your model is, because that's what is making you money. The trouble is, it turns out that a lot of these quant hedge funds had happened to develop really similar models. So their trades were all very highly correlated. Now, there are a bunch of quant hedge funds, and a small group of them had to sell a bunch of their assets. They had to sell a bunch of their assets, the price of those assets went down, which meant the value of the other quant hedge fund's portfolio went down with it. That started triggering the odd margin call, the odd investor got a bit concerned, they started pulling out not just of the original group that had to sell, but of the other quant hedge funds as well. So suddenly, all of these quant hedge funds were having to sell assets. That was triggering more margin calls, they had to sell more assets, more investors left. And what happened, it's really, look it up on a chart, it's a quant quake. Within a couple of days, the market plummeted because there were enough of these quant hedge funds around, all selling at once. You had a rush of sellers, no buyers, and liquidity completely dried up in the market. The market recovered because there was no underlying fundamental reason for it, but there was still a massive plunge. GFC, the credit markets, same thing, right? Everyone wanted to borrow, no one wanted to lend, so there was no liquidity in the market. It's what we call a liquidity black hole, and we look at that in week 4 as well. And the last thing that's really hard to put into your quantitative risk models is human capital and the family home. I said this yesterday, human capital, it's really hard to put a price on, and the family home, you're not going to get it updated at regular intervals to see how it's correlated with your super portfolio, for example. Or at least maybe someone would, but not very many people. So all of these things mean that it's important to consider the numbers, but you need to recognise that they're limited, right? Quantitative measures only take you so far. You need to understand the underlying fundamental sources of risk as well. This gives you another example of how risk can depend on essentially your investment horizon, or who the investor is, but the example here is the investment horizon. You've got the exact same asset, which is the S&P 500. You've got monthly returns, and you've got 10-year real returns. If you're a short-term trader, you're going to care about this graph on the left. If you look at the red line, that's the 5th percentile. So 5% of the time, there are short, sharp drops in the S&P 500 that will result in a return of worse than -6%. If you're a short-term trader, these drops, that's what you're going to be worried about, because any one of them could wipe you out. But if you're a long-term trader focusing on the next 10 years, you can ride out those short-term drops. What you care about are 10-year periods where the real return is negative overall. As you can see, they happen less frequently, and they're also pretty much all black swans. We have World War I, the Great Depression, World War II, the stagflation of the 70s. And this last bit is really interesting because we had both the tech wreck and then the GFC only about 6 years apart, right? We're always taught to believe in a 10-year business cycle. There was only 6 between the last 2. And by the way, we're getting awfully close. In fact, we're pretty much at 10 years now, which is why more and more people are starting to say, where is our crash? And it might be coming sooner than we think. Okay, so you can see that if you're a long-term investor, it's not the short-term volatility, it's not the quant quake that you care about, it's the black swans. That's if you're a long-term. If you're a short-term trader, it's not the black swans so much as the quant quakes, the short, sharp drops in performance. There's a couple of other things to consider when it comes to your investment horizon. One is changes in the investment opportunity set. So there are some assets that didn't exist several decades ago that do now, for example. Does anyone know when the first gold ETF was traded? or created? It was only 2003, and it was actually by Graham Tuckwell, if you know the Tuckwell Scholarship at ANU. So it's only since 2003 that gold has been easily tradable by making it, by listing it as an ETF, right? Which means that you don't need to worry about how on earth to store the damn bars of gold. You can just buy or sell the ETF like a share, which means that investing in that commodity becomes a lot easier, and it's a safe haven, which is very valuable. Risk of capital loss versus reinvestment risk, we've already covered. Remember, that was the example I gave as to whether the 3-month Treasury bill or the 10-year Treasury bond was risk-free would depend on the time horizon. Serial correlation is something that you need to be particularly aware of with stocks. What happens with shares is it tends to exhibit positive momentum in the short term, 3 to 12 months, and mean reversion in the long term, over 3 to 5 years. That actually has an implication for your risk. If we start with momentum, which is positive serial correlation, what it means is that well-performing stocks tend to keep performing well over the next 3 to 12 months, and the losing stocks tend to keep losing. So if you have a strong return at one of the best performing stocks, it's likely to have a positive return for the first 3 months, then for the next 3, then for the next 3, then for the next 3. But if you have a poorly performing stock, negative return is going to get worse and worse and worse. So what that means is, if your investment horizon is only 3 months, it's actually of lower risk than if your investment horizon was a year, because the negative return for the first 3 months only gets worse and worse over that full year. The positive gets better, but remember, risk, we're focused on the downside, which means that within the 3 to 12-month window, risk increases as the horizon lengthens. But once you get into the 3 to 5 year time, we move into what we call the negative serial correlation, which means that if you have a stock that's been going down in price for the past 3 years, then chances are it will revert back to the mean over the next 2, which takes the edge off your downside risk. So if you have a 3-year horizon, your risk will be more than if you have a 5-year horizon, because over the 5-year horizon, mean reversion kicks in, whereas it hasn't had a chance to if your horizon is only 3 years. So over the long term, once you get into the 3 to 5 year period, your risk reduces on average as your horizon lengthens. That's particularly unique to equities. There are some other asset classes that do have mean reversion and momentum in returns, but in equities it seems to exist in almost all countries and in almost all time periods. Right? That short-term momentum, long-term mean reversion is a very common thing. And we've already talked about this last point, which is the influence of the measurement period under thin trading or appraisal-based valuations. If either thin trading or appraisal valuations is an issue, then what you're going to have is smoothed returns and therefore understated risk, particularly if your return frequency is shorter than the time between trades or the time between appraisal valuations. So this is a great way to actually start to look at the underlying fundamental sources of risk, the fundamental risk approach. By the way, I don't remember if I said yesterday, I wanted to flag, you guys have a lot of examinable readings this week. They're quite big. It's an unusually heavy week. And the reason is that I've given you a lot of readings that we actually come back to in week 5, but I've given you the examinable readings now so that when it comes to week 5, the work on the reading side is already done. And I'm thinking by week 5, you guys are going to have a lot of exam prep and assignments to do. So the readings like the liability-driven investing and the fundamental risk approach reading for this week, you will go through it in a lot more depth in lectures in week 5. but you won't have additional examinable readings on those topics. So the work's already going to be done. I didn't want you guys to freak out about what you saw this week. So in the fundamental risk approach, it's essentially a qualitative method. You're not focusing on the quantitative data. What you're doing is you're taking the overall economy and breaking it up into fundamental risk sources. You start with the overarching risk, which is the risk of the economy as a whole. Fluctuations in the total income available in the economy. Now, to a large extent, that can't get diversified away, right? Think about the economy as a pie. What we're talking about is fluctuations in the size of the pie. When the economy is doing well, most asset classes are doing well, people's portfolios are doing well. When the economy is shrinking, most asset classes go down with it, as do people's portfolios. So risk number one is difficult to diversify, but what you can do is try to be diversified for risk number two, and that is the way that that income is split up into different sources. We call this income share risk, and remember, if the economy is a pie, risk number two would be changes in the size of the slices of that pie. You have the overall income in the economy. Some of it will be paid out as wages. Some will go to the government via taxes. Some will be paid into the housing market via rents. Some will go to companies as profits, some to debt holders as interest, and so on. The risk is that you are too concentrated in only one or two of these slices, and if another slice that you're not exposed to expands, and it shrinks the slice that you are exposed to, you lose out on your slice and you don't have an offsetting gain from the slice you're not exposed to. So let's talk about that as an example. Think about a superannuation fund. Their two biggest holdings are equity and debt. They are exposed to the profit share and they are exposed to the interest share, but they can't get exposure to tax revenue, and they can't really get exposure to wages, and wages is the biggest slice of the pie. So let's say that the economy stays the same, but wages go up. Of these slices, what's going to get hurt? What's going to shrink if wages expands? Profits, that's right. Because remember, wages are an expense, they have to get paid before you can realise any profits. So a super fund will not benefit from the increase in wages, but will be hurt from the decrease in profits as a result of companies having to pay their workers more. So what can they do? It's difficult, but they can get an indirect exposure to wages by investing in housing. Because typically when incomes are higher, people have more money to spend on property and on rent. So if you're exposed to housing, you can gain from the increase in income to housing, in rental income. So it's all about thinking, where is my risk? Where are my exposures, and can I diversify them away? Risk number three is fluctuation in valuation. In other words, it's changes in the amount that you can take your slice of pie and go and sell it for in the market. And that's going to be affected by things like inflation, changes in risk aversion, which will affect your discount rates. And all of those combined lead into your asset prices and returns. This isn't an exhaustive list. You should also consider things like liabilities. You've got a liability-driven investing reading this week, and we look at it more in week 5. Illiquidity, which we look at next. Home bias, where you have too much invested in your home country. And systemic risks as well. The next thing we're going to look at is illiquidity risk, which essentially relates to it's the cost and the ability to transact. So the idea is you risk taking either a haircut, where you have to trade at a worse price, or a perm, where you can't trade at all. And the trouble with illiquidity risk is that essentially when you need to trade is typically when you can't, or when it's very difficult and you have to take a big cut in price. Right? And so we say it's like taxis in a storm, because it's only when everyone wants to catch a taxi and there are no taxis available because the ones that were there have already been taken, that you suddenly realise that you're not able to achieve what you wish. Right? It's when everyone wants to sell an asset that there aren't enough buyers, so you can't sell it at all. Illiquidity is investor specific, right? So first of all, time horizon is going to matter. If you need to trade right now, then you might need to take a haircut. If you can afford to wait, then it might be that liquidity returns to the market and you don't need to take a haircut after all. So it's all about whether you need to trade immediately or whether you can afford to wait and exist with a suboptimal portfolio in the meantime. And the last thing is, if confidence